Welcome to the B.F. Anderson Technical Report for December the 16th. I've got my daughter Amy here with me, who's a portfolio manager with the firm, and we're going to be discussing some of these indicators. However, I wanted to call your attention to a book called The Battle for Investment Survival by Gerald Loeb. You have to realize this book was written in 1936, and it was after the Great Depression of 1929. And the whole emphasis of the book is that sometimes you have to take defensive strategies seriously because, if you read the title, it's a battle just to survive. Now, Gerald Loeb was the founding partner of E.F. Hutton and Company, and he was very quoted and a very smart man, and it's an excellent book. But it really basically says there are certain times where defensive measures are pretty necessary. Now, the big news going on in the media right now is the rise in inflation. So I've got the producer price index here. You can see the acceleration to the upside. Last week, it was announced that the producer price index jumped 6.8%, the highest reading since 1982, which was 6.2%. However, it turned out that the 6.2% in 82, and if you remember, the Federal Reserve Chairman was Paul Volcker, came in and pretty much shut inflation down, and then we entered a very major long-term bull market. So I think the real question here is that are we just at the beginning of a inflationary cycle, or is this going to be a short-term peak? We'll have to see. But I do want to emphasize on these indicators that we're really looking for not predictive indicators. We're just looking for indicators that tell us where we are now and what type of actions as investors we should be taking. Now, as you can see here on the NASDAQ, we've rolled over, gone into a correction here, broke the 50-day, rallied, made a lower high. Now we're breaking down again. It's just not a really good time right now, and we have to just be defensive in our thinking. However, on a long-term basis, we're still in an uptrend. There's no ifs and buts about it. The rule on this particular indicator is that if we break below the 35-week moving average for 2 consecutive weeks on both the NASDAQ and the S&P, that would be a sell signal. Now, actually, it could be even the beginnings of a bear market. So here are the mid-cap stocks. You can see the market is not broadening out. We're breaking down, failed to make a new high, breaking down again, close to breaking that 200-day important moving average. Here's the New York Composite, same thing, rollover, breakdown, a failed rally, breaking down again. This is just not a healthy looking situation. Here's small caps really getting hit hard here. This is, risk off. So, high, rolled over, failed to make a new high, breaking down, has broken below the 200-day moving average. Here is the S&P 500, which is actually holding up the best. However, we did break down. We have failed to make a new high and breaking down below the 10-day moving average. However, is probably the strongest looking index. Again, on the long-term picture, it continues to look constructive. On the 3 economic indicators, this is really amazing to me. Interest rates are basically going nowhere. We're at 1.4 on the 10-year Treasury note. Oil prices continue they've come down, basically moving sideways. Financial stocks pretty much following interest rates, not really going anywhere. Now, on the new lows, we're seeing some troubling signs here. Again, remember, this is the leaking boat indicator. In other words, when you get accelerated new lows that are more than 40 a day, it is a warning. Here we have the yield curve. Now, what we've got here, just to understand the yield curve, we got the 10-year Treasury yield versus the 2-year Treasury yield. Right now, that spread between those two particular securities is only 0.77, so we're seeing some real flattening out here. And as I've said in the past, this has been a very reliable indicator on recessions, because once you invert, you get the recession, you invert, you get the recession. Hopefully we don't invert, but it is moving in the wrong direction. Here we have the bull-bear sentiment reading, somewhat neutral. I believe if you look at your report, you're going to see that the the CNN fear greed index is around fear at this time, but did recently get into extreme fear. So this is somewhat of a positive because it means people are moving to cash. Now here is the put call ratio. We're seeing some improvement there. However, like I've said in the past, this is more of an indicator that can be quite dramatic in how you use it. Now the junk bond ratio, again, we're comparing high yield bonds to treasury bonds. Again, not looking good. The ratio is deteriorating. It has broken below the 200-day. This looks somewhat recessionary. I mean, it's hard to say, but it doesn't look positive. Here is the volatility index. We got a big spike in volatility last week, however, settled down, kind of moving back up again here. The rate of change was quite dramatic. I mean, we've seen a drop in the VIX of around 27% in the last 10 days. So that's an improvement. The percent of stocks above their 200-day moving average. Remember, the rule here is this has only happened, by the way, 4 times in the last 10 years where we break below 25%. Now, right now, we're at 26.91, so we have not broken that 25%. Now, at 25%, that means that 75% of the NASDAQ stocks are below their 200-day moving average. If we break below 25, the rule goes like this. It's happened 3 out of 4 times in the last 10 years where we drop as low as 15%. So it could mean the correction has more to go. Now, this is very important, and Amy, I'd like you to kind of comment here on the aggression index. We think this is a fairly important indicator right now.
Okay, so basically with this indicator, we're going to take you on 2 views here, but this is the tech portion of the stock market, which is the NASDAQ, compared to consumer staples, which kind of reflects more of a value risk-off perspective. And as you can see here, if we go all the way back to last year when the pandemic hit, you can see around February we fell out into March and then April, and then we had a beautiful year of growth focused stocks. But then here we are coming all the way back to where we are in December, and we're having a bit of a free fall action. So the sellers are in control. This is not a growth stock cycle that we're in. And so the next slide.
Well, let's mention here, where do you get the sell signal on this indicator?
The sell signal would have been whenever it crossed over the
below the 40 week.
Right.
So in other words, we've gotten, and I think another thing to note here as well is that when we saw the last sell signal, which really didn't turn out to be a sell signal, just somewhat of a head fake, but it was pretty gradual, and also the 40 week was somewhat in an uptrend. As you can see here, the 40 week is kind of rolled over, flattened out, and the drop has been precipitous. It's been a very dramatic drop.
Yes.
So going back and doing a little back testing, what would you notice here, Amy?
So we went all the way back to 2007, 2008, 2009. This is around the subprime mortgage crisis, and you can see the same activity where that very distinct sell signal is being given in the growth side of the market, where it's falling below the 40-week. It's basically just sharply declining, and it went on like this for a very long time. Hopefully we're not in the same predicament, but this is just another way to show when the sellers are in control.
I think the analogy here that makes sense is that if you're going down a railroad track and a train is coming at you at a very high speed, basically just get off the track and let the train go on by, because you can always get back on the track again. So in other words, if this turns out to be that high-speed train and you got off the track, you're going to be pretty happy about it. But if you go back and look one more time here, we could just see it come down, stabilize, and get going again. But right now, it's just not looking that positive.
And just remember, technology truly is the leader in the market. If something like Campbell's Soup or McCormick Spices is leading the market, then we're not truly in what I would feel is a buyer's market.
You have to realize value stocks, generally speaking, are very low profit margin companies, a lot of labor because they usually mass produce something. It's really a mediocre investment, but they are leading right now because they're defensive. So let's get into the top 5 just to kind of see what's going on. This is Ambarella, had a very nice uptrend going here. However, started to break down a little bit, rallied again. Now it's breaking down again. I would continue just to watch this one. On Arista Networks, however, this is the same business as Cisco Systems. This is telecom equipment having to do with the infrastructure of the internet. You can see here gap up on earnings, somewhat of a pullback, kind of formed a cup here and is now forming a handle. So a breakout above 135 would be very constructive, especially on above average volume. Here we have a new company called ArcBest, which is trucking. And you can see here, it pretty much gapped up, however, somewhat failing, moving sideways at best. I would continue just to watch that one. On Marvel Technology, again, the semiconductors have been strong, the softwares have been strong, but in this particular correction, we're seeing a lot of weakness. So on Marvel, earnings gap came up, was looking like it was going to go into an uptrend. However, it does appear to be failing the gap up. Now you had another gap up right here, which it broke below, not positive. Here's on semiconductor, another semiconductor. Again, we got the gap up on earnings, nice uptrend, pretty much holding the uptrend, but we would continue to watch. So if you have any questions, give us a call. Thank you very much.
Thank you.